folks. I'm going to bring in now Lonski Group President John Lonski and LSEG, London Stock Exchange Group Director of Consumer Research, Jharonne Martis. Jharonne, let me just start with you, because I think you're a Walmart fan. I kind of remember you digging Walmart a little bit here. Were you surprised, or how surprised were you from what we heard today?
Well, what we've seen in our LSEG data and what we've heard from Walmart, Target, and even Macy's today is that the consumer has become very value-oriented, and it's those promotions which are going to lure them really to open up their wallets this holiday season. Having said that, we still are bullish on Walmart for the holiday season, especially on their e-commerce service that continues to gain those high-end consumers through their membership services.
I mean, well, this seems, ironically, this seems like the environment where Walmart should thrive when people are looking for value, right? I mean, but still, it
is the one place to go. There is no other place to go. It is the number one place if you're looking for value. Even that high-end consumer is trading down to Walmart. So this is the best positioned discounter that we have going into the holiday season. You
know, John, though, there's another part that Lydia just mentioned, though, and that was the CFO saying how fast things changed. I'm reminded of Hemingway, slowly and then suddenly kind of thing, like, and I feel like this is what's going to happen. This is why I've been afraid of the Fed and the lag effect. Because, I feel like no lag effect, keep hiking, all of a sudden, bam! I mean, he's saying that the world essentially turned upside down in 90 days.
Charles, you are exactly right. I wish I had the chart in front of me. I'm talking about M2 growth that's a consequence of Fed policy. Back there in 2020, 2021, when the Fed was easing aggressively, M2 growth went up like this. I think it peaked at about 25% year over year. Then they put the brakes on in a manner never seen before. And M2 growth, there's no more M2 growth. It's been shrinking. This has no historical precedent regarding the dramatic aggressive easing of policy, followed by the Fed pressing very hard on its monetary brakes. Who knows where this is leading to?
Well, if consumers are any clue, that consumer sentiment report was an unmitigated disaster. What I found intriguing about it, I was, at the University of Michigan. What I found intriguing about it was that for them, and I don't know how they break it down, but they say it could be people are worried about the economy because of inflation or deflation, right? I mean, they kind of put it in the same basket. I'm not sure everybody knows how to articulate that to someone surveying them. What's the main thing you think that's needling the consumer all of a sudden? Did they just run out of money?
No. In fact, they're still spending money. If you look at Chipotle, Darden stock today, those are
But those are like rich people in New York City.
No, what I'm saying is...
What about the Darden in Butte, Montana?
Even Hilton just hit an all-time high. Hilton hotels. The restaurant and hotels are consistently outperforming the retailers. Consumers might not be spending and buying things, but they're still going towards the services.
We started to show off with YOLO, though. Isn't that part of the YOLO movement? Like, okay, I've got $100, I'll go spend it at the Olive Garden rather than anywhere else.
It has slowed down, but it's still outperforming retail.
John?
That's unsustainable. I've never seen an economy receive sustainable, recurring economic growth from spending on services like restaurants and hotels. It simply doesn't happen. And you're talking about deflation. We already have deflation with durable goods. CPI tells us that durable goods prices were down 2% from a year ago. Non-durable goods prices were up by just less than 2%. So all the inflation problems with services, and that's going to cure itself. That's going to get out of the way once we get over this temporary bout of rent price inflation.
There's another red flag that I think is glaring us right in the face. It's called West Texas Intermediate, gasoline, oil, crude. What the hell is going on? We're almost under 70. I thought, really, October 7th, one of the ugliest days in human history. But from a stock market point of view, from an economic point of view, you start thinking crude is going to go $90, maybe $100. No way in the world, October 7th, we'd be saying soon at this pace, we'll be with a 6 handle on oil. How does that happen unless it's deflationary, unless there's a global recession?
That's exactly right. I mean, for all practical purposes, China may already be in a recession. I think right now China is exporting deflation to the rest of the world. That's what I'm reading. That's what I'm hearing. And this drop of the price of oil, despite the horrible situation in the Middle East. And also, remember, we have OPEC trying to restrain production to push prices higher. What are they doing? They're declining. I don't think there's one expert who follows oil that thought oil prices would be falling at the end of 2023. And that's exactly what's happening. And that is, I think, proof that the world economy is doing very poorly. Forget about that 4.9% real GDP growth you had in the United States in the third quarter.
Jharonne, I'll give you the last word. I mean, obviously, cheaper gas helps the consumer, but also it could be cheaper because the consumer isn't using it. Like, this is supply and demand dynamic. Is there any company out there? You mentioned Walmart. You still like Walmart.
Right, Walmart.
What about Amazon in this environment?
Amazon is still poised to beat earnings estimates and post a positive surprise in the fourth quarter. Also, we are positive on Lululemon and Free People because they have a cult following. And then Abercrombie & Fitch is still one of the favorites for teen retailers right now.
It's come out of it. It's like the phoenix of retailing,
Yes.
right? I've forgotten all about it. I thought it was down for the count. One last, you look like you want to tell us. You got to tell us one more thing.
Well, I think prices are going to go lower. And as far as holiday shopping is concerned, ask for money at Christmas and then go ahead and spend it at year's end in early 2024. The economy will naturally get slower and slower until after the Fed begins to cut rates. We may be shocked at the depth of Fed rate cuts in 2024 if, as you hinted about, we're facing a problem with deflation.
I'm going to pick this up in the next segment with Daniel DiMartino Booth because there are some interesting signs there. Jharonne, it's great seeing you. Of course, John, always great seeing you. Thank you both very much. Appreciate it.